The dollar became the global currency because it sits at the center of global trade, global finance, and global trust. Countries do not use the dollar by accident. They use it because it solves real economic problems that local currencies cannot solve at scale. First, you need to understand what a global currency means. A global currency is the currency most countries use for trade, reserves, loans, and investments. Today, that currency is the United States dollar. More than half of global foreign exchange reserves are held in dollars. Most international trade invoices use dollars. Even countries that do not trade directly with the United States still price goods in dollars. This dominance started after World War II. At that time, Europe and Asia were economically damaged. Factories were destroyed. Infrastructure collapsed. Economies were weak. Meanwhile, the United States had a strong industrial base, strong banking system, and large gold reserves. This gave the dollar credibility. In 1944, global leaders created a new financial system called the Bretton Woods system. Under this system, countries pegged their currencies to the dollar, and the dollar was backed by gold. This made the dollar stable and trustworthy. If a country held dollars, it believed those dollars had real value because they were tied to gold reserves. This agreement placed the dollar at the center of the global monetary system. Countries needed dollars to stabilize their currencies. Central banks started storing dollars as reserves. Over time, this created a network effect. The more countries used the dollar, the more useful it became. Even after the gold standard ended in 1971, the dollar remained dominant. Why? Because the financial system built around it was already deeply integrated. Global banks, markets, and institutions operated in dollars. Changing that system would have been costly and risky. Another major factor is global trade. Most international trade uses the dollar as the settlement currency. For example, oil, commodities, and shipping contracts are priced in dollars. If a country wants to import oil, it usually pays in dollars, even if neither country is American. This creates constant global demand for dollars. This demand strengthens the currency. The United States has the largest and most liquid capital markets in the world. Investors trust US Treasury bonds because they are seen as low-risk assets. When investors want safety, they buy dollar assets. This behavior strengthens the dollar's global role. The depth of US financial markets also matters. Large institutional investors need markets where they can move billions without causing instability. The US market provides that scale. Smaller economies cannot match this level of financial depth. Institutions also reinforce dollar dominance. Organizations like the International Monetary Fund and the World Bank conduct large portions of their lending and operations in dollars. When countries borrow internationally, they often borrow in dollars. This means they must earn or buy dollars to repay debt. Debt structure is a major reason the dollar stays dominant. Many developing countries issue dollar-denominated debt. This creates structural demand for dollars. If their local currency weakens, their debt becomes more expensive. So they prioritize holding dollar reserves to manage risk. Another critical factor is trust. Global currencies require trust in political stability, legal systems, and monetary policy. Investors trust the institutions of the United States more than most countries. They believe contracts will be enforced. They believe financial data is transparent. This trust attracts global capital. Central banks around the world hold dollar reserves to protect their economies. If their local currency weakens, they can use dollar reserves to stabilize exchange rates. This practice makes the dollar a global safety tool during crises. Crisis behavior proves dollar strength. During financial crises, investors rush into dollar assets. This happened during the 2008 financial crisis and the 2020 global market shock. Even when the crisis starts in the United States, global investors still move toward the dollar because they view it as the safest large-scale currency. Another structural reason is payment systems. Global banking systems rely heavily on dollar clearing networks. Many cross-border transactions pass through US-linked financial systems. This gives the dollar operational dominance in global payments. Monetary policy also plays a strong role. The Federal Reserve controls the supply of dollars and sets interest rates that influence global capital flows. When US interest rates rise, global investors shift funds into dollar assets to earn higher returns. This strengthens the dollar's position. You must also look at global reserves. Over 50% of central bank reserves are in US dollars. The euro, yuan, and yen hold smaller shares. This reserve preference shows institutional confidence in the dollar's stability and liquidity. Liquidity is a key technical advantage. The dollar market is the most liquid in the world. This means large transactions can happen quickly without major price disruptions. For global trade and finance, liquidity reduces transaction risk. The legal framework of the US financial system adds another layer of strength. Property rights, contract enforcement, and financial regulations attract foreign investors. Large investors prefer environments where legal risks are low and predictable. Technology and financial infrastructure also support dollar dominance. Global stock exchanges, commodity markets, and derivatives markets heavily use dollar pricing. This standardization reduces complexity in global transactions. Network effects cannot be ignored. When most global actors use one currency, it becomes inefficient to switch to another. Businesses, banks, and governments already operate in dollars. Switching systems would require massive restructuring of contracts, reserves, and pricing models. Trade invoicing patterns also show dollar dominance. Even trade between two non-US countries often uses dollar pricing. For example, a country in Asia might trade with a country in Africa but still settle the transaction in dollars. This shows the dollar's role as a neutral settlement currency. Exchange rate stability is another factor. While the dollar fluctuates, it remains more stable than many emerging market currencies. Stability reduces risk for long-term contracts and investments. The role of US government debt markets is also important. US Treasury securities are considered one of the safest investments globally. Central banks and institutional investors store wealth in these securities. This creates constant demand for dollar-denominated assets. Geopolitical influence also reinforces dollar usage. The United States has strong global trade relationships, military alliances, and economic partnerships. These networks indirectly support dollar adoption in international agreements and contracts. Sanctions and financial regulations also highlight the dollar's global power. Since many transactions pass through US financial systems, the dollar gives the United States significant leverage in global finance. Countries understand this and still use the dollar because alternatives lack scale and stability. Now compare the dollar to other major currencies. The euro has strong regional influence but lacks unified fiscal policy across all member states. The Chinese yuan is growing but still faces capital control limitations and lower global trust. The Japanese yen and British pound are stable but do not match the scale of US financial markets. Another overlooked factor is corporate behavior. Multinational companies operate globally and prefer a stable accounting currency. Many large corporations report earnings and conduct international contracts in dollars. This standardization increases global reliance on the currency. Foreign exchange markets also reinforce dollar usage. The dollar appears in nearly 90% of global forex transactions. This means it acts as the intermediary currency in most currency exchanges. Safe haven behavior is critical. When political or economic uncertainty rises, investors shift into dollar assets. This demand strengthens the currency during instability, reinforcing its global status. Banking systems worldwide hold dollar accounts to facilitate trade and investment. This creates an interconnected dollar ecosystem. Removing the dollar from the system would disrupt global commerce. Another key driver is seigniorage. Because the world demands dollars, the United States can issue currency that global markets willingly hold. This gives the country economic flexibility that other nations do not have. Confidence in monetary policy consistency also matters. Investors analyze inflation control, interest rate management, and transparency. The dollar benefits from long-term policy credibility compared to many emerging economies. Global education and financial training also contribute indirectly. Finance professionals, economists, and institutions study US financial systems extensively. This creates institutional familiarity with dollar-based operations. Digital finance and global fintech platforms still default to dollar pricing in many international services. This shows that even modern financial systems continue to rely on the dollar framework. Another important aspect is transaction cost efficiency. Using one dominant currency reduces conversion costs in international trade. This efficiency encourages businesses to keep using the dollar instead of switching between multiple currencies. Military and geopolitical stability also support confidence. Investors associate the dollar with a stable geopolitical power structure. Historical inertia plays a strong role. Once a currency becomes dominant, replacing it requires decades of systemic change. Infrastructure, contracts, and reserves create high switching costs. Global investment funds also allocate large portions of their portfolios to US markets. This continuous capital flow sustains dollar demand across global investment channels. The role of the US Department of the Treasury is also significant. Treasury policies influence bond issuance, debt markets, and fiscal stability, which shape global confidence in dollar assets. International lending markets further strengthen the dollar. Many syndicated loans, sovereign loans, and corporate bonds are issued in dollars. This creates long-term structural reliance on the currency. Inflation management also affects global perception. A currency used globally must maintain relative price stability. The dollar has historically maintained lower inflation compared to many developing currencies, which reinforces trust. Economic size is another core factor. The United States has one of the largest economies in the world. A large economy naturally supports a large and widely accepted currency. Finally, the dollar remains global because no alternative currently matches its combination of liquidity, trust, institutional support, financial depth, and global network integration. Replacing a global currency requires not just economic strength, but also decades of consistent institutional trust, financial infrastructure, and global adoption patterns.